Good morning. Thank you for joining us this morning for this business acquisition financing webinar. Just a couple of logistical matters that I want to mention to you this morning. Please keep in mind that everyone is automatically muted when they enter the webinar. Please make sure to keep yourselves muted throughout. The presentation will last approximately an hour. The first portion will introduce the SBA and the SBDC. Then Stacy Sanchez from CDC Small Business Finance will discuss her topic for approximately 40 to 45 minutes. The last 5 minutes or so will be dedicated to questions and hopefully many answers. We will be answering questions but holding on to them until the end. In order to ask a question, please look at the bottom or right-hand side of your screen. You will find a chat button there that you can use to ask questions. We will then collect all of the questions and ask Stacy or Rachel at the end on your behalf. So we'll get started right now. I want to introduce myself. My name is Rachel Baranek, and I'm the Deputy District Director for the SBA office that covers Orange County and the Inland Empire. We're actually located in Santa Ana, and we're a federal agency that basically our mission is to help small businesses get started and grow and hopefully become large businesses. The SBA has been doing this since its inception over 60 years ago and has helped millions of small business owners by providing the financial support, contract assistance, counseling, and other forms of assistance that businesses need to succeed. SBA's programs include financial and federal contract procurement assistance, management assistance, and specialized outreach to women, minorities, armed forces, veterans. SBA also provides loans to victims of natural disasters and specialized advice and assistance in international trade. I would like to point out that we do have a website that's quite informative. It is at www.sba.gov. And if you click on local assistance, you can find your local SBA office, along with many of the resources that are available to you as a small business. My contact information is also on there under the Santa Ana District Office, and also others on our staff that are there to help you with various skills and things that you need to build your small business. So I'd like to talk a little bit about the SBA and some of its programs. SBA is probably best known for small business loans, but there is so much more. Capital is loaned through participating lenders, about 5,000, and the SBA guarantees a percentage of that loan, which reduces some of the risk to lending partners. These types of loans and the terms are many and varied. The SBA also provides loans for disaster assistance when there has been a presidential or SBA agency declaration. Think fires, which we just had actually in Orange County and also in the Inland Empire, floods, earthquakes, drought, so on and so forth. Those are disaster loans. We also do government contracting assistance. The federal government purchases about $500 billion in goods and services, and the goal is for 23% of those contract dollars to be awarded to small businesses. So if you have a product or service that can be sold to the government, our office and resource partners can help you get contract ready and pursue certifications. Our office and many other offices across the nation conduct webinars and workshops to help understand the process. And then there is help with management technical assistance. Our field offices and our funded resource partners offer one-on-one business counseling at no cost. Imagine that, no cost. This is all basically funded by the federal government. They also provide hundreds of workshops a year, mostly at no cost, and some with a nominal fee. You may have heard of, and if you haven't, you're going to hear about it, Small Business Development Centers, Women's Business Centers, and SCORE. They all have counselors and mentors from many backgrounds and expertise to work with you. studies actually show that small businesses that work with a mentor are much more likely to succeed than those who do not. So today, this program is being sponsored by the Orange County Small Business Development Center. And as you can see on the slide, they provide free one-on-one business consulting on various topics, starting from startups to expansion, also online marketing, finance, QuickBooks, and of course, international trade. They also provide mentoring on access to capital, loans, and lines of credit. And very important to our economy is international trade. So new to export businesses and export expansion are also able to receive counseling from the Orange County Small Business Development Center. And in addition to that, seminars and workshops are available to you. You can check out the training schedule on their website. Services are also available, of course, in English, Spanish, and Vietnamese. In order to join the mailing list, you can actually text to OCSBDC to 22828, and you can receive a text asking you to reply with your email address, and then you'll be on their mailing list. Have you liked our page yet? The Orange County SBDC has a Facebook page, and there is the link to it. It's basically facebook.com/OCSBDC. One of the things that the Orange County SBDC does is they help you with a new state law with respect to electronic filing and payment requirements. Employers are actually required to electronically submit employment tax returns, wage reports, and payroll tax deposits to the EDD, Employment Development Department. And beginning in January 1, 2018, all employers will be required to electronically file and pay. And for more information, you can click, I believe you can click on that link that's highlighted there. And you can also ask the Orange County SBDC for assistance. So our next speaker is Stacy Sanchez, and I'm going to tell you a little bit about her. She has a very impressive background. She is a senior community loan officer with CDC Small Business Finance. CDC Small Business Finance is an SBA 504 lender, also a 7A lender, and an SBA micro lender. They happen to be the #1 lender in Community Advantage and 504 lending across the nation. She specializes in loans under $250,000 for new or existing businesses and or business acquisitions, which you're going to hear about today, in California, Arizona, and Nevada. Ms. Sanchez received the 2014 SBA Small Business Financial Services Champion Award for her work to assist small businesses beyond her job description. Ms. Sanchez has been with CDC Small Business Finance since 2003 and has been working with small business owners for over 30 years. And she's only 32. Amazing. She started her career with a family-owned business and spent 10 years helping them grow from 6 locations to 60. Ms. Sanchez has worked as a consultant for several small business development centers, a minority small business development center, and an SBA consulting company. She was with the U.S. Small Business Administration, Santa Ana District Office for 5 years as the lead economic development specialist and public information officer, and I enjoyed working with her tremendously and was very sorry to lose her. Ms. Sanchez has been vice chair of the City of Santa Ana Workforce Investment Board since 2008. She is vice president and immediate past president of Cameo, which is a statewide membership organization of micro-enterprise organizations and lenders. She owns a small business with her husband and is active at her children's school, serving as Delta Booster president. Take it away, Stacy.
Thank you, Rachel. Thank you so much and welcome. Today we're going to talk a little bit about small business financing as it relates to purchasing an existing business. Yes, Rachel mentioned I work for CDC Small Business Finance, and CDC means we're a certified development company. CDCs are certified by the SBA to administer the 504 loan, which is used primarily for fixed assets like commercial real estate. We're a private, nonprofit, mission-based lender, and our goal is access to capital. There's roughly 260 CDCs across the country, all of them providing some types of lending to small businesses. We are a little over 35 years old. We are the nation's largest CDC. We provide a variety of loan programs in California, Arizona, and Nevada. I'm in the Irvine office and work pretty closely here with the Orange County Small Business Development Center. I'm going to highlight today a little bit about what we look at when we're evaluating a loan request, again, focusing on business acquisition. And I'm going to try to highlight what are rules that all lenders, all SBA lenders have to fall under or have to abide by versus what might be a credit box. And a credit box would be the individual's lender's appetite for risk. You know, how much risk are they willing to take? And usually these credit boxes are defined by these 5 C's of credit. Each lender is going to have a level of risk that they're willing to take on based on these 5 C's. So CDC, Small Business Finance, is a community advantage lender. This is a specific SBA loan program under the SBA 7A umbrella. 7A loans can be used for a variety of purposes, buying a business, buying equipment, working capital, startup funds, even real estate. You can use an SBA 7A loan up to $2 million?
$5 million.
$5 million. But the Community Advantage Loan Program has a cap of $250,000. So occasionally you'll hear me reference Community Advantage rules versus other 7A rules, and then SBA rules versus what's a credit box, okay? So the 5 C's of credit. One of the things I think is most important for all small businesses to understand is how they are viewed in reference to these 5 C's of credit. So overall, the 5 C's are, and some lenders call these the 3 C's, they might have 6 C's, but they're all the same. They've just, you know, shuffled the C's around, so to speak. But we look at cash flow, which is the capacity to repay the loan, collateral, which is the lender's exit strategy if for some reason the loan doesn't go, if there's a default or the borrower needs to exit the business. Capital, how much is invested into the business. Credit, personal credit of any owner, 20% or more, and character, your experience or how you handle decisions in your life. So let's talk a little bit about all 5 of these C's of credit in a little bit more detail. So cash flow is the capacity to repay the loan. Does the business show the ability to make the loan payment? And in this case, in a business acquisition, what we're looking at is the business that you want to buy, its most recent tax return and financial statement to see, is the business making enough money that it can afford to make the loan payment that you need to take out in order to acquire this business. In evaluating the cash flow of the business, we look at the net income plus any non-cash add backs, such as depreciation or amortization. And if the owner of the business is paying themselves, we look at the amount of money that they're paying themselves, and we add those back to the net income to see how much cash is available to make the loan payment and or to pay you, the new owner, if need be. We also will look at what impact the intended changes you as the buyer are going to have on the cash flow. So for example, if the business you're buying has 5 employees and you think it would be just fine with 3, then we may add back the wages of those 2 employees that you'll be eliminating when you take over the business to see what impact that can have on the cash flow of the business. Again, if there are personal draw needs from the buyer, if this will be income replacement for a job perhaps that you've lost or will be leaving when you buy this business, we'll look at what your personal draw needs are to cover the cost, the debt of your household. So we don't just look at the business's ability to make the loan payment, we will also factor in what impact your income in your household has on the cash flow of the business, meaning If there are other sources of income in your household and the business that you're buying doesn't need to pay you, then we're not going to deduct a wage for you, the new owner, because we see there's other income in your household.
That makes sense.
All right. So let's move on to collateral. I'm going to come back to cash flow a little bit when we talk about the valuation of the business that you want to buy in the next slide. So collateral. The SBA requires that the lender take all collateral owned by the business. In a business acquisition, you typically will be a startup or viewed as a startup by the lender because you're forming a new entity to buy the business that you want to be the owner of. So you're looking at a business that's a corporation. You plan to form an LLC so that you and your partner can run the business. Your LLC is a new business. And when you take the loan out to buy that existing business, the collateral that the lender will ask for at a minimum is a lien on the business assets of your new business. You may also be asked to pledge personal assets as additional collateral for the loan. So for example, if you own a home and the lender views, if you own a home and you have equity in that property, the lender may ask you to pledge a lien on your personal property as additional collateral on the loan. You will be asked to personally guarantee the loan. That's not really collateral, but just as a note, all SBA loans require a personal guarantee of any owner of 20% or more, or anybody who's viewed as a key management employee.
I have a question on if you own a piece of real estate, your home, and you have no equity in it, will they still take that as collateral?
That is a credit box choice. The lender may choose to take it as in anticipation of future appreciation of that property, but in all likelihood, it doesn't make sense. It's cost prohibitive to get an appraisal on your property, to take a lien on it when there's no equity in it. This is all going to be dependent upon how strong the cash flow is of the business that you want to buy, and the overall presentation of the request. So the third C is capital. This is how much money you are bringing into the project. Let me just stop a second and explain what the project is. So in a business acquisition, the project is the purchase price plus the amount of working capital that you will need for your opening day balance. So keep in mind that when you buy a new business, they don't give you the money left over in the bank account to start your opening day. You have to have money to pay the first and last month's rent. You've got employees that will need to be paid, utility deposits, etc. So you need some opening working capital. So we're going to call that our project. So each lender has SBA does not recommend 100% financing, but some lenders will do 90% financing for business acquisition. Some will do 80% financing. My slide indicates 10% business acquisition would be your injection, because with CDC Small Business Finance, we'll do 90% financing for business acquisition. And that means if the purchase price is $150,000 and you need $50,000 working capital, our project is $200,000. Your capital investment would be 10%. You would need to come in with $20,000, and we would finance the balance in the business acquisition. So your 10% should be savings, not debt, although some lenders will allow you to borrow against your own equity. So for example, if you have equity in your personal residence and you take your 10% out in the form of a home equity line of credit, some lenders will allow that because it's your money. Same thing for borrowing against a 401k. Again, that's a credit box choice and something you would need to speak about with your lender. You can finance a portion of the capital injection if the seller is willing. So using my example of a 10% capital injection in business acquisition, if the seller finances 5% of that 10%, so you've come in with $10,000 and the seller is carrying a promissory note of $10,000, that would be allowed in order to have you meet your capital injection. However, the seller must be willing to stand by for 24 months. 2 years, not 240. I'm sorry, I missed that on the slide. So it's the seller must be willing to stand by for 24 months, 2 years. I don't think you're going to find a lot of sellers willing to stand by for 240 months, but there are ways to work if your lender is willing. Credit. We do look at the personal credit of any owner of 20% or more. An acceptable credit is, again, a credit box decision of your lender. The SBA only requires that we use prudent lending standards to determine acceptable credit. Our minimum is 620. Again, each lender is going to have a little bit different minimum credit score. We typically will evaluate or review the credit of your spouse if you have one, and even if they're not involved in the business. Here in California, for example, a community property state, we want to know what the debt load is of the household. So even if your spouse is not an owner of the business and will be not working in the business, if they are, if we're dependent on their income in the household to help the deal cash flow, we'll ask them to be a personal guarantor. Reviewing their credit and evaluating your household debt load does not automatically make your spouse a personal guarantor. That's a credit decision of the lender. But again, if your business is dependent on your spouse to help cover personal expenses or to make ends meet, then so are we, and we'll ask that person to be a guarantor. Character. This is sort of a vague term, but it really is often referred to as your experience in the industry, your responsiveness to the lender. You know, when we ask you for documents or we ask them questions, are you quick to get back? Have you consistently paid your contractual obligations on time? If there's been a problem, have you gone back and made good on those problems? Have you committed crimes in your past? All those types of issues are looked at and are part of your character. But it's, you know, your choice of decisions in the past and how have you handled those choices going forward. So I want to make sure you understand that you're not going to be penalized for mistakes you've made all your life. What we're looking for is what have you done recently, and how are you handling that adulthood now, so to speak.
What about bankruptcy? How do you look at somebody who's filed bankruptcy in the past?
Good question, good question. Bankruptcy is a credit box decision. So at CDC, for example, and a lot of community advantage lenders are similar, we're going to require 3 years post-bankruptcy. And we want to see that you've begun to rebuild your credit since that time. Okay. But each financial institution, each lender is going to have their own rules regarding post-bankruptcy, post-foreclosure, post-short sale. They may not be willing to work with you at all, or they may be willing to work with you after a certain period of time. So again, that's a credit box choice. But character is what you want to try to explain. You know, you worked your way up in a job, for example. You started as an hourly person and became a manager. That shows character and determination. So it's up to you to try to highlight some of those points, all right? Okay, so business acquisition financing. How is it different from just applying for a loan for an existing business or for a startup? Well, primarily because it involves somebody else's information, namely the seller. So when someone contacts me about buying a business, one of the first questions I want to know is the purchase price and how that was arrived at. What's it based on? Is it based on the assets of the business, or is it based on what you anticipate your return on your investment will be? Typically, what I want to do is a valuation of the seller's tax return, ideally right away, so we can find out whether or not the valuation supports the purchase price. SBA is very particular about how the lender values the business, the rules regarding valuations, and the ability to verify the information used in that valuation. This is why SBA lenders require the seller's tax returns, because the tax return is a sworn statement to the federal government that this is in fact how much income and how much expenses that business had in that year, and I can verify that the information they're giving to you on the tax return was in fact submitted to the federal government. We get a transcript of the tax return to verify that the information we're looking at is the same information that was submitted to the IRS. 3 years, if the business has been in existence for that period of time, are typically used in the valuation. Now, if the purchase price is below $250,000, the lender can use their own internal valuation process. So, for example, we have a software program that we use. A lot of lenders use the same software program, but may require, because SBA requires that they do, have an outside appraisal done of the business. It's required if the purchase price is over $250,000, the lender will have to get an outside appraisal of the business. So, remember we talked about in cash flow how I would add back that you're going to eliminate a couple of employees to make the business more profitable or more lean, for example. Well, in the valuation, I'm not likely to add back the changes that you will make in the management of the business that will make the business more profitable, because I don't want the seller to benefit in the purchase price for the value that you're bringing as the new buyer to the business. So we look at the seller's tax returns and we'll use the net income, depreciation and amortization, again, because those are non-cash expenses. Those are reasonable add backs. We add back the owner's salary, and typically it's not uncommon to add back a few things that are obvious, like maybe auto. Let's say you're buying a CPA firm and there's an auto expense. Well, we'll probably add that back. That's pretty neutral. But things like employees, or you're going to reduce all the rent, etc. I mean, those types of add backs don't get done in the valuation. So the valuation helps us determine what the project cost is. It's the purchase price plus the working capital. You are typically going to be asked to put together a business plan, how you plan to run the business, why you're qualified to do so, and changes that you expect to make, along with projections that tell what the business will look like when you're the owner of it. And then again, we're looking to see, does the business that you want to buy support the loan that's needed in order to purchase it? So the valuation is really key in determining whether or not the business is going to qualify for a loan. You need to be so strong as a buyer as well. Remember, I'm looking at your personal credit, your ability to come in with a capital injection, and your ability to convince us in your business plan that you have the experience and wherewithal to run this business successfully. But the balance of the cash flow and the value is going to be dependent on the business that you're wanting to buy. Anything, questions?
The only thing I would add is if you need assistance putting together the business plan, your projections, getting all that together, certainly reach out to the Orange County Small Business Development Center or the Small Business Development Center in your neighborhood, in your area, or SCORE or Women's Business Center. They are there to help you. And the one-on-one mentoring, counseling assistance, there's no charge to that. So you can sit down and talk to a mentor and, get feedback from them on what you're proposing to submit to your lender.
Perfect. And I work very closely with my Small Business Development Center.
Yeah.
And we go back and forth when we're putting deals together. Okay, so I wanted just to sort of highlight the Community Advantage Loan Program, alternative loan programs. These are non-bank loan programs. The Community Advantage Loan Program, again, there are lenders across the nation offering the SBA Community Advantage Loan Program. This is a non-bank SBA loan. CDC offers it in California, Arizona, and Nevada. We do loans $50,000 to $250,000 under this program. All Community Advantage lenders typically have a target of startups, for existing businesses, expansions, business acquisitions. We're targeting businesses that are veteran-owned, new businesses, businesses located in low to moderate income census tracts, and businesses that employ individuals that live in low to moderate income census tracts. The rates are prime-based, prime is currently at 4.25. That's the base rate. And then there's an index plus, so prime plus 2.75 up to prime plus 6%. To give you an idea, if you were qualified for a bank loan, the bank would charge you something like prime plus up to prime plus 2.75. So the bank is capped at prime plus 2.75. So community advantage lenders are doing loans that the banks aren't doing, and our rates are higher. We're not in competition with them. So we prime plus 2.75 to prime plus 6. Terms are 7 to 10 years. Again, one of the big advantages of an SBA loan over a bank conventional loan is the term, in that they're fully amortized with a longer term to allow you to be able to afford to borrow more because the payments spread out over a longer period of time. SBA, go ahead.
I just have a question. Can the term be longer if you're purchasing real estate?
Oh, good question. Yes, thank you. Real estate loans under Community Advantage would be 20 or 25 years. Okay. Well, we're in Southern California, though. There's not a lot of property under 250, but I'm sure that's not the case across the nation.
Yeah.
SBA microloans are loans made by nonprofit entities. They borrow the money from the SBA and then reloan it to the small business community. CDC Small Business Finance is a micro lender. We make microloans in San Diego, Orange, Riverside, Los Angeles, Ventura, Imperial, and San Bernardino counties, and various counties up in Northern California as well. We do 5 to 50,000 in this particular loan product. Some micro lenders, SBA micro lenders, will do below 5,000. Depends on your area. Viable businesses that do not meet bank requirements, and for one reason or another it's not the best fit to put them in the SBA Community Advantage loan program. We fix our rates in the micro loan program, 9.5 to 10.5% fixed for a term of 3 to 5 years. One of the great things about the SBA microloan program is it comes with a requirement that the borrower receive post-loan counseling. So it's a great way to, for the lender to make sure that the borrower is on the right track, and for the borrower to get some great consulting services as part of the loan. I think it helps when you see some deals that got made. So I always like to go over a couple of success stories, meaning loans that were done, that to help you see how it was structured and where those 5 C's come in. So these are deals that I've done recently or in business acquisition. So for example, there was a gentleman called me, he wanted to acquire a website and some software that the website owned. So the project was $300,000. He formed a new S Corp. So it was an S Corp that was getting the loan. The project was $300,000 and the purchase price was $250,000. $50,000 was working capital. Now this is all intangible assets. So it's really a goodwill financed deal because he took over the website. So there's not a lot of equipment. It was software. It was, intellectual property, so to speak. He had applied at a bank and been turned down and referred to me. Good credit, 746. What we took as collateral was a UCC-1, which is UCC stands for Uniform Commercial Code. That's in California. It's just the way that you put a lien on the business assets. And UCC-1 means we were first in line. And then we also took a lien on their personal residence. This was a projected cash flow deal, meaning that we could look historically at how the business was doing, but what we did this was based on the projections and cash flow projections of the borrower. And because we had collateral, we were willing to make this on a projections basis. So good industry experience, that's one of the strengths. He had good outside income. Apparently there was great historical cash flow. There was some weak internal financial information from the seller. So while we had good cash flow, we were questioning some of his bookkeeping, for example. But the cash flow that was projected in the business plan made sense to us. His strong personal credit, and his collateral that were available. I'm not seeing where I put in his injection, but he came in with 10% on this particular loan. You can do a stock sale, which may make sense for you. In this case, it was great because the borrower's personal credit was not really strong, and by buying the stock of the corporation that he was purchasing, he's able to maintain the employee identification number of the business that he's buying and all the historical credit of the company. Now, because it was a business that, like a body shop that needed some of that business credit to buy inventory, to buy, paint, supplies, and things like that, it made sense for him to spend a little bit more with an attorney to put a purchase agreement together that involved the stock. There's a lot more details involved in a stock sale, but in this case, it made sense. So our purchase price was $295,000. Remember, that's over $250,000, so we did have to get an outside appraisal. We conditioned for that as part of the approval process, meaning that we approved the loan, but we weren't going to fund it until it met the appraisal requirement. That's a condition. In addition, the borrower needed $50,000 in working capital. This was somebody who actually worked at the business. The seller owned the building and he wanted to retire, and he really wanted his employee to have the business. That really helps because the seller needs to be cooperative. Again, this came from a bank. He had tried to get a loan from a bank, but they weren't wanting to do it, partly because his credit was so weak. 680 is not a bad score, but it just wasn't, in this case, he was young and didn't have a lot of history. We took a UCC1 on the business assets as our collateral. There was a little bit more of a complication here that I'm not going to go into, but the owner was still making payments on the building, so there was a little bit of a hiccup there. We had great cash flows. It was a very strong business. Look at that, 1.99 at year end and 1.95 at the interim. And what that means is that the business was showing $1.99 available to pay every dollar that was due. That's what that 1.99 means. The issues on this one, it was very good experience. We needed the seller to carry a portion of the loan, and we were in a pretty weak collateral position. But we felt pretty good about it because the borrower had good character and showed his good experience and knowledge in the business and industry. He'd been already an employee and had been managing the business. So his character was really key in getting this deal done. And the valuation did work out. It was a good little deal, life-changing purchase for this particular employee.
Injection on this one was how?
He came in with 5%, and the seller had to carry a portion of it and wait the 24 months to get paid.
So the two success stories you just talked about were Community Advantage?
Yes, both Community Advantage loans, $250,000. Okay. This case, we combined an SBA micro loan and the seller loan in order to make it all come together. Okay. This is a little flower shop. Again, she had been an employee of the business for quite some time, 10 years, and wanted to buy the business. The seller was ready to retire. The problem we ran into, because we had great cash flow, the borrower's credit was good, there was collateral available, she'd had great experience, is that her landlord would not extend to her a 10-year lease or extend to her an option so that she could extend her lease for a total of 10 years. SBA requires, in many cases, where the location is important to the success of the business, that the term of the lease match the term of the loan. So in this case, we couldn't get that to happen. So the seller was willing to carry half the loan, and we went with a 5-year loan for $50,000 and got it done that way. So just wanted to bring this one up because I wanted to point out that sometimes the lease terms can dictate the term on your loan and can make a big difference in whether or not the deal cash flows. So these are, talk with your lender about the term of the loan and the term of the lease that you need for negotiating any final lease terms on your business acquisition. Did a little food truck acquisition recently as well. He was an employee again, looking to buy the business that he was working for, a food truck. It was a $110,000 project cost plus including working capital. The borrower came in with $31,000 and the loan was $122,000. So project cost $110,000. That doesn't add up. I must have missed out on some. Oh, and plus working capital. My mistake. I apologize. Credit was $650,000. We took a lien on the business assets, but in this case, we also took the pink slip on the food truck. That's pretty common when lenders do moving collateral or moving vehicles like that. We want to take the pink on the vehicle. Great cash flow. Look at that. $5.90 for every $1 due. And he had great experience. 3 years in the industry, he had a culinary degree, and had been with this particular business for at least a year.
How long a term on this?
This was 10 years.
10 years.
Mm-hmm. Hopefully he'll pay it off before then, but yeah, it's a 10-year term.
Is there any penalty to paying off Community Advantage loans?
Excellent question. No, the term of the loan is what dictates if there's a prepayment penalty. So anything under 15 years, there's not a prepayment penalty. You just need to give notice of your intention to prepay.
And is the interest rate fixed or variable?
The interest rate is variable, and it changes on a quarterly basis depending on when prime changes. So if your loan is prime plus 3.25, 3.25 is your index. When prime changes, prime goes up to 4.5, you'd be at 4.5 plus 3.25. So when prime adjusts, your interest rate will adjust as well.
And on an SBA microloan, is the interest rate variable or fixed?
In our case, and again, that's a choice of the lender, but usually they're fixed rates.
And we do recommend shopping around for lenders, but starting with your own lender first to see if they will do the loan, either commercially or with an SBA guarantee backing it. And of course, CDC, Small Business Finance, is available with Community Advantage. There are other CDCs that also do Community Advantage as well as SBA microloans. I will tell you that on our district website, we do list a list of our participating lenders, and we also do a monthly lender ranking, which shows you which lenders are making loans. At this point, do you have any other comments, Stacy?
I can answer some questions if there are any questions. You know, one of the ones that I see a lot come up is when someone's attempting to buy a business that's maybe one location within a company. So for example, a corporation has 3 locations and the borrower comes to me and wants to buy just one of those locations. Mm-hmm. Oftentimes those aren't SBA eligible because the seller is not able to produce tax returns specific to that location. So it would require basically that the seller was willing to give you a profit and loss and a balance sheet for each of those locations for the last 3 years, along with their tax returns for the last 3 years, so that you could verify that those 3 location profit and loss statements added up to what was reported on the tax return. And then I could go to the IRS and confirm that what was reported on the tax return was in fact correct. But what we find is in my 15 years, I have never had a seller willing to extend the profit and loss statements for all their locations to meet that requirement. And it's typically because they're selling the one that is the least profitable, and that will be obvious to the lender if they were to provide all that document.
Do you do loans on franchises?
Oh, all the time, all the time. Usually the franchisor has some sort of transfer fee, and the franchisor will also require that the buyer be eligible. Mm-hmm. But that's a great way to buy an existing business. You know, not only do we have the seller's operating history, but we have the franchisor's operating history, and can see their success. SBA keeps track of loans that go to franchises and what their default rate is per franchise. So that's really helpful for a lender.
Okay. We have a question from Wendy, I believe it's Zong. What kind of immigration legal status of the borrowers is required?
SBA will allow, you must be either a U.S. citizen or a legal permanent resident, which is like a green card holder, as used to be referred to. Foreign nationals can be eligible for SBA loans as well, but not in a startup situation. So in a business acquisition where you're having to form a new entity to buy, a foreign national wouldn't typically be eligible. You'd need to be a legal permanent resident or a United States citizen.
Yeah, there's another question from Jimmy Boyce. How can we value a business?
Well, you know, you can have an outside appraisal done, which is going to run you, you know, $1,800 to $2,500, but the lender needs to own the appraisal, so I don't recommend that you do that ahead of time. If you're working with a broker, the broker can oftentimes give you an idea of whether or not the buyer's purchase price makes sense. And again, your lender. If you have the documentation or can get the documentation to your lender, they can often also run a quick valuation and let you know whether or not this is something that's going to fly. A lot of your small business development centers and SCORE chapters may have work with CPAs or accounting specialists who can also help you determine what the value of the business might be while you're trying to negotiate a purchase price.
I know there used to be kind of a ballpark rule of thumb for valuing a business, like had to do with the revenues. Do you know what that is? 2.5 times or something, or I forget exactly what it was.
You know what? I know what you're talking about,
Yeah.
but no, I don't remember that. And sorry, somebody asked me to re-show the microloan one. So hold on a second here. I'm sure there's a better way to do this. Sorry, there we go. Microloan slide. Again, SBA microloans are offered nationwide by nonprofit lenders. You can look on the SBA.gov website, your local assistance, and look for loans. SBA microlenders should be listed, or they'll allow you to plug your address in and determine where there's a microlender in your area. The other really great service offered on the SBA.gov website is the Lender Match program, where you can enter your loan request or information of what you're looking for, and the SBA will send you lenders who are interested in your loan request in your area. So that's called Lender Match, and that's on the SBA.gov website.
Okay, we have a question from Levance Northington. Can the seller carry more than 5%, especially when the purchase price is $3 million?
There's not a limit on the dollar amount that the seller can carry. Remember, we want to have the project amount, so the purchase price has to be verified and the valuation has to be supported by the seller's tax returns. And you need to come in, the buyer needs to be able to meet the lender's capital injection requirement, but the seller can carry a large portion and you can borrow a smaller portion, or you can borrow a large portion and the seller can carry a smaller portion. It all depends on you and your lenders and the seller's willingness to make sure that the lender is ahead of them on the collateral position.
So the next question is from Wendy. Regarding the first C, cash flow, if the seller doesn't, run the business very well and the current cash flow is not enough to pay the loan, but the buyer is confident to turn around the acquisition, how would you calculate cash flow? I guess that would be more projection.
Yeah, exactly. We would be using your business plan and your revenue projections to justify how you're going to make the business more profitable. Keep in mind that if the seller is not running a profitable operation, but the purchase price is not supported by the tax returns, the lender, we are not going to allow you to enter into more debt than can be justified by the valuation. So if you see a gem, but you have to overpay for it, you'll end up having to overpay for that with your own money. You won't be able to borrow more than the valuation supports. Does that make sense?
Yeah,
Okay.
That does make sense. And again, somebody's actually asking a quick method to appraise to get an idea. That's what I was talking about earlier. The only suggestion I have, and I'll probably do it when I get back in the office, is Google, rule of thumb business valuation. You might be able to do that. I think it's like I don't know, maybe 2 times the revenue or something to that effect.
Yeah, and there is a 5 times weighted average type formula. There's all kinds of different methods, but the issue again comes back to compensating for, you know, a management salary. What can you add back? So there's, even though it may be a quick and simple valuation, there's a lot of miscellaneous factors that might go into it that can make the difference in whether that valuation makes sense. I mean, there's a reason people are experts at appraising businesses, because it is an expertise.
But I can totally understand wanting to get like a ballpark figure of what a business is valued at. But in order to do that, you need to see their tax returns, you need to see their financials. So I have a question for you, Stacy. Do you ever use the RMA ratios
all the
for
time.
businesses?
All the time.
That's something for you out there, you know, to look at. Those are ratios that are based on business industries, and you know, it kind of gives you an idea what other businesses of that type, you know, are doing as far as, like, you know, debt to net worth ratio, all sorts of cash flow ratios. So that's kind of a baseline, you know, generic, you know, in the industry that you're buying.
So Wendy, your question: if the buyer currently has an SBA loan, can he refinance it? If the buyer has an existing SBA loan and is looking to take out another SBA loan to buy another business, that would be up to your lender to determine whether or not it made sense to refinance it or to give you a second loan. If I've misread your question and the seller has an SBA loan already, we wouldn't refinance it. A new loan would be issued that would pay off the seller's SBA loan, and you, the buyer, would have a new SBA loan.
Yeah, correct. Any type of SBA refinance is looked on a case-by-case basis, and it's usually done to improve the cash flow for the borrower. Namely, you know, if your cash flow, you know, is reduced by 10%, then they will consider an SBA loan to refinance that debt.
Right. Yeah, but it can be sticky.
And again, I would urge you to go on our website, sba.gov. There's a lot of training available on that website. If you're up at 3 o'clock in the morning, sorry, we just got another question.
Oh, the ratios.
If you're up at 3 o'clock in the morning, you can take a training class on the sba.gov. There are many tools available, how to put together a business plan. There are various website links on our SBA.gov website that are very helpful, you know, when putting together a business plan, a marketing strategy, so on and so forth.
These ratios, somebody asked the question of where do we obtain the ratios from? Rachel was mentioning the RMA ratios. That stands for Risk Management Association. So I would Google that. I'm sorry, I don't have that website at the tip of my fingers, but that's a really good resource, right. Risk Management Association.
The SBDC or SCORE may be able to help you with that. You can also call my office if you need something, because we have access to that. My direct phone number is 714-560-7441. And my email, it's all on our website. It's Rachel, R-A-C-H-E-L, .Baranik, B-A-R-A-N-I-C-K, @SBA.gov.
You used to be able to get those RMA manuals at the public libraries as well, so you may still be able to see them there in person.
Right.
Fees for SBA loans, that's another great question. SBA does have an SBA guarantee fee. Right now there's a sale though. If you get a loan under $125,000, there's no SBA guarantee fee. Otherwise, it's about 2% of the guaranteed portion. So for example, a $200,000 loan, the lender would receive a 75% guarantee, so you'd pay 2% of that, of 75% of the loan amount. Typically lenders have what's called a packaging fee. For example, in our case with CDC, we are 2% of the loan amount to a maximum of $2,500. $2,500 is kind of a cutoff for a lot of packaging fees for lenders. And then you typically are going to be asked to pay the actual booking costs of the loan. So for example, the credit reports, the title reports, the UCC filings, those types of fees are usually taken out of the first disbursement. So along with the SBA guarantee fee. So for example, if you were going to receive $50,000 in working capital, they may take $5,000 or $6,000 out to cover your SBA guarantee fee and then your booking fees. It may only be $2,500, but you get the idea.
And certainly your first step from your next step would be to contact the Orange County Small Business Development Center. You see that on the slide. Schedule a private consultation and basically find out about their workshops and seminars, such as the webinar we did today. It's valuable information, and the more you use the SBDC and our other resource partners, the more likely you are to succeed in your business.
Thank you.
Thank you, everybody, for joining us today, and use all the resources that we talked about. And good luck to all of you.